No upturn in sight for the Chinese economy. Thank you for joining us for another Bank of Cardiff newscast. Chinese manufacturing activity fell to a 6-year low in the latest chapter of the slowdown in growth currently being experienced by the world's second biggest economy. China's president was swift to defend his government stock market intervention in a speech delivered in Seattle during his recent state visit to the U.S. He claimed that although the economy was, quote, under pressure, it was nevertheless on the way towards growth, and that the stock market had reached a phase of self-recovery. Well, it's not a view shared by everyone. After an average annual growth rate of 10% for 3 decades, China's economy has slowed significantly. Last year it was just 7.4%, with many economists believing the true figure to be a good deal lower. IMF forecasts stand at 6.8% for next year. World markets were buffeted by more than a month of volatility after China devalued its currency and intervened in the stock exchange in an attempt to stabilize its financial markets, fueling concerns about the state of the country's economy. The president's Seattle speech presented a more hopeful picture, although data released minutes after the address showed renewed signs of weakness, with the Caixin Market Manufacturing Index falling to 47, the lowest since spring 2009. Nervousness about the extent of China's slowdown has been rife among investors, particularly after the Federal Reserve name-checked China as one of its reasons for not raising interest rates in September. China's factories slashed output, staff numbers, and prices at a faster pace as the rate of new orders fell. Chinese manufacturers employ millions of workers but are reeling from the effects of a weak recovery in major markets overseas. Beijing is trying to wean the economy off its reliance on trade and investment in favor of domestic spending on goods and services, but the transition is challenging. The IMF described the transition underway in China as, quote, moving to a new normal, characterized by slower yet safer and more sustainable growth. China's previously dynamic record has been tempered by the rise of an aging population, together with a narrowing of the technological gap with the rest of the world, and what could be seen as excessive investment levels that are diverting resources from other sectors of the economy, including domestic spending. Experts are now speculating as to whether China's trajectory will be smooth or will suffer a hard landing as it flirts with the possibility of recession. Forecasts for the next few years put growth at 5% or less, which would have massive impact on China's contribution to the global economy. Even those countries with little in the way of direct trade with China will feel the pinch if they supply into countries that sell to China, or if they export commodities whose price in international markets is affected by weakened Chinese demand. Well, this resetting of the Chinese economic model has a knock-on effect around the world. The scaling back of lending and investment may steer the country towards a soft landing that gives China the opportunity to regroup and rebuild its battered economy. But if the slowdown becomes a full-blown recession, it could have more serious repercussions all around. Join us later this week for another Bank of Cardiff newscast. And remember, all of our newscasts are available on our website. That's bankofcardiff.com/newscasts.